Hello, Greg.
Hey, Mike, how are you?
Good. You can see we're getting official. We've got a countdown.
Yeah, I like that. It's pretty fancy.
Get my door, my office shut. Yeah, we're just trying to be a little more timely. The futures markets open exactly at 9, and they close exactly at 9 or 3:05. So we should, as a team, be able to respect that, right?
Yeah, I like it. I like it.
Well, I am going to get rid of that. Well, four, three, two, one. Oh wow, it even beeps. Uh,
It's
so
official.
did you make it till midnight on New Year's Eve this year?
Ah, I had to have the help of my kids and an alarm. Kind of dozing off, and I think the bowl games that day. What it was, Michigan, Georgia, and then that the Alabama Cincinnati game. But that Michigan, they were just terrible games, so it was tough to stay up.
Yeah, I didn't make it this year. First year in a long time that I hadn't. I was pretty gassed. We went to northern Wisconsin, and I drove kind of through the middle of the night to get there. Um, and then we went out and played outside in the snow all day.
Yeah, I think I saw a picture on LinkedIn of maybe your wife posted it snowmobiling. Do you guys snowmobile up there?
Yeah, we did. My sister has a couple of snowmobiles, and we were pulling the kids on their snowboard.
Right, right, right. Yeah, that looked like a lot of fun.
Yeah, fun for them. They took some falls that probably would have put me in the hospital, and they get up and giggle about it. Oh, to
Yeah,
be
yeah, no, for sure, for sure.
to be young. All right, so let's kick this off. It's lunch with no, I'm sorry, lumber futures from the free seats.
There you
Uh,
go.
if you want, Greg, let's share your screen and get this thing going.
Do you see it? Are we good?
Oh, I'm sorry. It's my bad. There we go.
Okay. We'll jump right in. So, I know off the air, Mike, you kind of mentioned the word consolidation, and yeah, I think at the very least, there's a triangle coil formation forming here on the charts, January and March, with the idea that the market is trying to consolidate. Are you going to break out to new highs? Do you officially roll over here? To be determined, especially with January still on the board. When we update the chart here week over week, this shows as of this morning or as of yesterday. I think this was as of this morning, 1187. January did trade up to 1195. The high from last week is 1199. So we're right on the precipice of that 1200 with the front month. Obviously, March is trading greater than 1200. On a continuation or on a January basis, there's a gap that was left back in May at 1225. So it'll be interesting to see if front month, if the January spot month here can get up into that 1225 area. From an EFP standpoint, as of, let me grab my calendar, we did two EFPs as of yesterday. We're up to 37 for the contract. So very small so far. My guess is there's going to be another probably 50 or so EFPs that still have to transact between now and Friday. And again, if you're being forced to buy January, then you're being forced to still pay a premium here relative to where cash is. And if I'm a betting man, I know that there are multiple Western mills, Mike, that have sold in this 1140, 1150 area. We'll call it an 1145. Even with Fraser still officially dragging behind in this 1120 to 1130 area, depending, whether it's Alberta or BC Wood.
Um, yeah, we talked a little bit about that consolidation. It feels like the cash market for trucks, what we're seeing on the platform, has the rise has kind of slowed or almost stopped. Multiple guys are coming back on with the same price multiple days in a row. Um, by no means have we seen a pullback. Yesterday, what we limit down yesterday, we're limit up today.
Briefly, yeah.
Um, so when I start seeing those kind of things happening, uh, a raging bull market doesn't go limit down.
Yeah, and I guess the counter argument. It was a Monday, and it's kind of the pressure relief valve that you're up, you're up, you're up. You need to relieve some of that pressure. I think the interesting thing yesterday is that if you would have closed limit down, technically, and I'll jump forward here to I'll come back to this, but I'll jump forward to a geez, I might have forgotten my oh boy. Pretty bad
Oh,
today, Mike. I forgot my March charts. I'll go back to January, but um, I forgot to add a March chart here. But and and I can pull it up this way too. But you were limit down going into the close. Somebody came in with a 10 lot right into that closing time period, took it off limit, and it took basically 10 cars to go up $10. So it was a positive close. You didn't close outside of that coil triangle formation. Let me see if I can pull up a March chart here, and I'll kind of show you what I'm talking about here. Let me do it this way. All right, here's DTN. Here's that March chart. So you can see with March here, you would have closed down kind of through this trend line here. Technically, it would have given some kind of, you would have been a limit down, house limit. Somebody bid it up and it kind of took it off there. So it never really gave a technical sell signal. So, of course, we're limit up today as a result. But again, to really say you're going to bring new fund type buying again, I think you're going to have that resurgence back up to the high here of 1250 to really see signs um, of new buying. I mean, the one thing, and I know I'm jumping all over here, but open interest yesterday. Let me get rid of this. Um, I will say the one thing that was interesting, Mike, yesterday with open interest. I'm sorry to bounce around like this, but if you look at yesterday with the majority, there was decent volume that traded limit down. So January obviously is in its liquidation mode. March open interest, even with that down move, was up 77. So, the $1 million question with 90% of the day being down hard on the day, is that new buying? Was that new selling? We thought that maybe that would have been the weekend and longs liquidating, and that would have been a lot easier to reconcile if March open interest actually went down. But with yesterday being that down day, and again, there was big volume that traded, or bigger volume that traded limit down. We built 177. It can't all be explained by January rolling into March. So what was that build in March open interest? And that's I don't have more questions than answers. We went up off of a down day yesterday, which is interesting.
now if you want to talk funds, that little bit of move yesterday is not going to
No,
spook a long fund. You
no,
need to have a fundamental lower low, lower high.
exactly.
So now, if tomorrow, let's just play out that we finish limit up today, and then tomorrow we don't go high enough to take out that the next high. Can we do that tomorrow?
Yeah, I mean, with today's close, let's assume we have limit up close today. You'll have expanded limit of $45, so you could take out the 1250. You could get up to
Okay.
you can get up to that 1284 area. So you can definitely re-engage the funds. If you're going to finish up here for the day, you definitely have the potential to re-engage the funds. The other thing I want to point out to people is that typically the commodity funds don't trade in the first 10 minutes of trading. They're really not market on the open type traders. They let the market set up. And the same can almost be said for the algo. Typically, you don't see them come in that first 10 minutes of trading. You're going to get the initial buy stops, sell stops, people that have to do stuff on the opening. Once you establish some kind of a trend, then you typically see the algo, and then you see the commodity funds engage thereafter. But typically they're not there for that first 10 up to the first 15 minutes, depending on what the market's doing.
Yeah, that seems about right. Yeah, so my senses are up that we could be topping, but it needs to show me this.
Yeah, and I would say I'll go back and to the beginning here, but I would say I would want some kind of technical confirmation on the charts here. Some kind of technical reversal outside trading day, breakout of this coil, some kind of technical confirmation that we're topping. The one thing that I'd be cautious in this kind of market here, I'd much rather attempt to pick tops with strength, fading that strength, then until this thing gives some kind of reversal technically lower, I'd be very careful in selling weakness in this market. That's where you have a tendency to get whipsawed, get suckered in, and then you get a day like today where, yesterday we're limit down, everybody's questioning, okay, is it a Monday? Are we over with? And then immediately today, you're limit up, kind of right back at it. So you want to be careful chasing weakness and trying to pick tops in a market like this until you get some kind of technical reversal.
Yep, for sure. Do you have the commitment of traders report? Because
I
last
do,
week
and I think
there's something to read in the tea leaves there.
yeah, for sure, and I'm glad you brought that up. So here's CFTC. This was last week. Managed money was kind of muted. If we skip forward to the most recent 1/4 release, you had this nice build of the managed money. The other thing that stands out is producers were just kind of in liquidation mode. So this is probably producer longs taking profits, commercial shorts kind of getting stopped out, margin called out, or just coming out of the position because they're liquidating the cash. But the big thing here, big two things, is an increase in managed money, and then also just the liquidation of the spreads. There are people that trade specifically spreads, Jan, March, and a lot of those people, as you start to lose the open interest in January, you just get to that point in time where you need to, good, bad, and different, you need to liquidate the trade.
Yep, for sure. And speaking of the spread, that March May spread, what are we trading here at? We're at 110.
It got up to 109.80. Yeah.
Yeah, so it's
Yeah.
right around 110. And in recent history, that's kind of middle of the road, which is really bizarre for me to say that.
Yeah, and so you can look at that two ways. Before we jump into those spreads, I just want to show this is a comparison of the CFTC numbers. It gives you the current week, it gives you the last week, it gives you 2 weeks, and it gives you a year ago. And the one thing I didn't have time to pull up, I wanted to pull up, and I'll do this for next week, but I wanted to show kind of, this gives you year over year, but I also wanted to show graphically where we were when we topped out last May, when we made the all-time highs. The one thing I think that immediately jumps off the page here is if you look at the net managed position, this is net commodity funds, okay? So look at commodity funds now versus a year ago. Their net position, managed longs, okay, managed shorts were pretty even a year ago, 638 versus 560. Net managed position was 79 contracts net long. The commodity funds kind of played both sides of this a year ago, whereas this year they're significantly long, 5-to-1 type long versus short. The other thing that jumps out here is the commercials position. And if I look at commercial shorts, look at the difference current versus a year ago. We have 604 shorts. A year ago, we were 1,300. Okay, longs 486, pretty close to last year. Remember the structure last year in that futures were trading at a pretty substantial discount to cash. So longs were incentivized. Okay, I don't want to chase cash. I don't want to chase the premium in physical cash. I'm going to own something. I'm going to own the discount in futures. Commercials had to sell that discount to just, look, we think the market, this is unsustainable. We're still going to sell. We're going to sell $300 under the cash market. Fast forward to this year, you still have a sizable long position. And when you look at total open interest, this gets magnified. But this short position is so insignificant versus a year ago based upon total open interest. So when I take these two numbers and compare them year over year, your commercial shorts are substantially less than they were ago. Shoot, sorry. Let me back up here. Your commercial shorts are substantially less than a year ago, and your managed money longs are substantially greater than a year ago, given the size of open interest. So when I compare this from a percent standpoint, this open interest versus last year, these numbers are even, again, more magnified, more substantial. So at the very least, look, this market can go higher. We know it can go to 1,500. We know it can go to some extreme number, but just be cognizant of the fact that when this ends, you have significantly less commercial shorts that have to short cover on weakness, and you have a significantly greater long fund position when they ultimately come out. They're not. Yeah, look, they look like heroes right now being long, but when this market rolls over and you go hard the other direction, you have less shorts to short cover. You have more longs to ultimately stop out. So at the very least, be aware that you're sowing the seeds when this flips. The structure can set up for that hard move lower. Just as severely as you go higher, you can set up for that, sharp destructive move to the downside as well.
Yeah, and that's interesting. That's just fuel to the fire to move down quick and fast. And we're not saying it's going to happen today. We're just saying when it does happen, it's gonna have a fury to it. Um, if I remember back in that big move up, everyone, we had $1,000, 1,000, and that was just going to be the ceiling. And I think
Right.
that's where a bunch of commercials hedged up, and they, I heard horror stories about, oh, I lifted my hedge on the way up because we were, cash was moving so fast, everything was moving fast higher. Um, they treated their hedge like a spec short.
Yeah,
Um,
no, and I think I think it's easy to say stay the course, and you have to be willing to margin it. The difficulty when it comes to production hedging is you're being asked to hedge something that you physically haven't sold, let alone produced. When you start to hedge in the back months, you're asking somebody to sell May, July, September at $1,000+ you haven't even thought about producing that wood, let alone selling it. So you have to, when it comes to the financial reconciliation, you're going to incur the immediacy of margin calls up front. So every day, your CFO, your CEO, hey, we got this margin call. Okay, send this money out. And when you have a market, I think at the high water mark, we were up something like 40 some days in a row. So just imagine getting a margin call where you're realistically having to finance this margin call day after day after day. You go from 1,000 to 1,700. Can you afford, is everybody on board to manage that margin call and sustain that pain? The answer is obviously, yeah, you should, because the end, the result was all things normalized. You go back to a normalized structure, you get rewarded, but you're having to front load all this cash toward a margin call when it's against something that you're not going to reconcile for 6 months, 7 months, 8 months, 9 months down the road based upon the contract that you're short. So
and then
it's easy to say that in theory. The practicality, when you get a year like last year, you better hope that the right people are on board and understand it to justify it.
and look, if the cash market runs higher than futures, it's the dynamics of exiting that trade. What you should do, you're hedged. Now your cash is more expensive than the futures market. You should buy that futures back and sell your cash. That
Yeah.
type of mechanism, that activity, is going to drive futures higher. Maybe that's kind of some of the things we saw
And
last
I
year.
see Matt's asking spec long, and my answer would be yeah. And the one thing I want to point out is that this seems to be driven by the commodity fund longs, where they finally decided, okay, we want to be long. And again, you look at some of the other basket of good commodities like energy, some of the other markets out there, they continue to push higher. But the one thing I want to, again, this short position, this has to do with fear of margin calls, but it also means that commercials, based upon market size, have a lot of bullets left in the tank. If this thing continues to surge higher, commercials are not overexposed as far as net shorts. Producers have lots of ammunition in the tank here. They have not fired anywhere near all of their shots here. They have lots of bullets to fire on a continued push higher in futures. So just be careful. You know, like there's a lot of commercial shorts that can come into this market.
Yep, for sure. So what are we seeing in the basis charts?
Let's jump back here. So the one thing well, I just want to and I know we're good on time here. So I just want to point out the other thing I want to point out here. Here's the S&P. So you see we have lower, higher highs, higher lows here. You have the Nasdaq. You have lower lows. So here's a
Yeah,
Nasdaq
that's
S&P.
a bearish pattern right there.
So because of interest rates, you have this flight of quality out of technology stocks into the Dow, into the S&P. Because of higher interest rates, money isn't free. You know, Nasdaq type tech stocks cost a lot of money to realize their potential. So when you look at the 10-year note, here's your pre-COVID 2020 interest rates. You're right back to where you were pre-COVID 2 years ago. You know, the 10-year bubbled above the 1.8 area. So all this free money that's been in existence is reverting back to pre-COVID type levels. And again, this is going to force the Fed's hand of higher interest, interest rate increases sooner rather than later to combat inflation. And when you look at here's 30-year mortgage rates, you're basically you've trended back to pre-COVID type levels. Now, look, historically speaking, this is still dirt cheap money, but it's not as cheap as it was 6 months ago, a year ago, a year and a half ago. So, that in tandem with inflationary pressures, does that mean anything for demand? So I just wanted to point that out. Here's crude oil, again, continues to higher highs, higher lows. So that's beneficial for lumber. And then we'll jump into basis here. And again, Mike, this was as of yesterday's close. This is last week. Cash was 1100. January was 1139. You jump forward. I used cash at 1140. January, this was as of yesterday's close. Obviously, this has changed now where January's back to carrying a premium relative to cash now. Jan again is 11 in this 1195 area. So you still have a premium even with spot month Jan here. Same thing in March. A week ago, we were 1100, 1144. Now we're 1140, 1209. So you're still carrying a premium in March. Same thing with May here. And then here is, you mentioned the spreads. Here is Jan, March. You've kind of flatlined in this negative 45 area, negative 40, negative 45 area. If it's going to follow the last couple of spreads, here's Nov Jan. You went off at 100 under. You can see what it did in the last 3-4 days of trading, how the spread collapsed. Sep Nov, kind of same thing. It flatlined and then collapsed into expiration day. So, do you get something like that where to incentivize to get people to take January? Does that spread have to get blown out to negative 70 plus? Or does January have to, God forbid, does January have to go to a discount to physical cash to get people to take the wood? And, the other thing I'll say with January is that if there truly is no wood out there, then January will command some kind of premium because at least you're going to be guaranteed somebody on the other side going into expiration. So we'll see how badly the longs want to continue to own January at a premium to cash, or at least a perceived premium to cash.
Yeah, did you pull the March May up? That's
Yeah, I'm going to do, here's your March, May. A week ago, it was in that negative 88 area. So there's your wedge coil formation. You broke out, you actually went up to a high of 109.80. And then that March, May right now is 102.10 at 112.60. And, so here's the thing, we just looked at Jan, March, how it's kind of mimicking the last two expirations. If you look at March, May from a year ago, you can see, March, May. So here's the beginning of January. It was somewhere in the 60 over area. It went all the way out to, by the time you got into the middle of February, it went out to the 160 area, zigzagged. So it'll be interesting to see, I'll jump back here. Does March, May mimic the last, does it mimic Jan, March? Does it mimic the last two, Sep, Nov, Jan? Or do you revert back to the spread structure we saw a year ago where, the spreads got blown out to that 150 to 250 type premium?
Yeah, I'm gonna keep a good eye on that March May. I think it could be the telltale for market direction. Um,
Yeah, no, I think it's something to watch. At the very least, okay, that the funds are going to chase March. So if you need to own something, do you need to own March $100 over May? Okay, maybe the spread does go to 130, 150 over, but at least with May, you're conceivably buying something at a discount to cash. This is where, the comprehension of spreads, do I want to own something $100 over the next month out? There better be a good justification. And that's the uniqueness of March right now, is that, okay, January, right now, I can buy Jan negative 42.70 under March. So March is the contract wrapped in gold right now, as far as that's where the speculator, the speculative longs are concentrating. That seems to be getting the most love from a spread standpoint right now.
yep. This is an interesting week. We're expiration week, so we have the data point of January to look at and talk about. Next Tuesday, that's history. We have nothing but March to look at. So I think we get this January rolled off the table here, and then we're probably going to see some sort of culmination in that March
Yeah,
contract. It's
yeah, and I think the other, I know we're starting to bump up against timing here, but the other thing I'll point out, this is just and thank you to Alex for putting this together on the fly here, but this is just a comparison of Western SPF 2x4s relative to the other species. So here's Eastern 2x4s, here's Doug fir, hem fir, Eastern Southern Yellow Pine. So you can see that, the one bullish argument here is that, well, SPF is the cheapest species out there relative to the other species.
the first thing I see when I look at that chart is that you don't see the divergence between the species like they're at right now very often.
No, no, I think it's especially with the three, like we're obviously Southern Yellow Pine is going to be, if it's not already, it is well on its way to becoming the dominant species. The other three kind of have a tendency to track each other, correlate better now, where Southern Yellow Pine is kind of detaching itself. So it'll be interesting to see, do the other species maintain this premium? Does spruce have to come up to narrow this? Do the other species come down? All to be determined. As far as open interest is concerned, we continue to see a build. We're up over 2,500, which is positive. On these moves to the upside, you want to be building open interest, not losing it. And then we talked about CFTC numbers. And then I know, we had, and I know we're bumped up against time. We got 2 minutes here, but I know we had talked about this hedge example of buying a March 950 put, selling a March 1250 call. This was back on 1228. We collected $27. So the net effect would have been being short, basically in this 1275, 1280 area. If I update that today, let me jump forward here. You can see that it's gone against me. It's upside down about $57. from when I put it on. So, markets go higher. There is the stuff doesn't always, I always love the examples where every example makes money. Well, this
Yeah.
example so far has lost
Well,
money, but it's an inventory, it's a production hedge, it's an inventory hedge. So you're still getting appreciation in your underlying cash.
yep, absolutely. All right. Well, I tell you, what, I'm going to keep a good look at that commitment of traders report and the March May spread. I'm curious to see how that plays out in the next week, 2 weeks.
Yeah, and again, all for next week, I will give an update on what the CFTC numbers looked like when we topped out back in May of last year, just to get a comparison of where the funds were, where commercials were, because I do think you brought up a point on that move from 1,000 to 1,700. That was very painful. You ended up tripping a lot of commercials, so we'll definitely compare that as well.
For sure. All right. Hey, as always, Greg, thank you very much. Insightful look. We'll see everybody next Tuesday. Let's join Ash tomorrow with tomorrow is Matt Beamer and Greg Riley, and then on Thursday with Matt Lehman. And then we'll see everybody back on Friday for the Smart Market Call.
Yeah, and the other thing, Mike, I want to say the podcast last week with the Southern Yellow Pine mill owner, I thought that was phenomenal, just to get there, like to actually hear a Southern Yellow Pine
Yeah,
talk about how they build out log deck and just the things that influence how it was just a great firsthand look. So that kind
sure.
of stuff is invaluable.
Absolutely. And, everybody likes to, throw mud at the mills. Oh, they're price gouging. Then you kind of put yourself in their shoes, and their time horizon isn't 6 months, it's 6 years.
Yeah,
So, yeah, if they can make some hay when the sun's shining, they're going to make the hay because the rain will be coming someday. They know.
yeah. I appreciate it, Mike. Thank you.